The last 2 months has seen continued momentum in each of the occupier sectors of the Irish commercial property market, with particularly strong volumes of activity recorded in the office and industrial and logistics sectors in the opening months of 2018. With large volumes of stock reserved in both sectors and several requirements currently active, we expect continued activity in both of these sectors over the summer months. Meanwhile, the retail sector of the economy continues to perform solidly, buoyed by continued job creation, with employment in Ireland having increased consecutively in each of the last 22 months. Indigenous Irish retailers and international retailers remain active, hampered only by a scarcity of opportunities in the better performing shopping centres, retail parks and high streets that they're specifically targeting. Development remains well controlled, which in turn is helping to support rental values in all sectors, with the industrial sector continuing to boast the highest year-on-year rental growth prospects. In addition to already strong volumes of demand, Brexit-related inquiries are likely to solidify further over the coming months as the UK's position on Brexit starts to become a little clearer, adding another welcome layer of demand in both the office and industrial and logistics sectors. Total returns from Irish commercial property remain solid, with total returns in the year to the end of the first quarter running at 6.8% on an ungeared basis. Demand continues to outstrip supply, with particularly strong demand for alternative investment opportunities, as well as core opportunities in provincial locations such as Cork. Sourcing core product continues to prove challenging, with an increasing proportion of transactions now being conducted off-market. Total investment spend in the first quarter of 2018 surprised on the upside, with almost 930 million of transactions recorded in the 3-month period, more than a quarter of which occurred outside of the core Dublin market. In the office market, activity continued at pace in recent months, following a very strong first quarter, in which an impressive 83,400 square metres of take-up was recorded in the capital. With a sizable proportion of accommodation reserved at present and several large requirements remaining active, the prospect is for continued momentum in this sector over the next couple of months. As has been the case for some time now, the largest transactions in the market are emanating from the expansion of existing occupiers as opposed to new entrants. That's not to say we don't have new entrants in the market. However, the largest transactions each quarter are primarily expansion. Although there are currently 37 office schemes at various stages of construction within the Dublin city centre market, it is encouraging that more than half of the accommodation with a 2018 delivery date has already been pre-committed. A scarcity of new accommodation for occupiers requiring premises in the short term will therefore continue to prevail for the foreseeable future. This in turn will provide a welcome boost for flexible office providers that can accommodate occupiers until such time as new buildings are ready for occupation. As has been the trend over the last couple of quarters, the growth of flexible office providers has continued in the opening months of 2018. Indeed, according to CBRE research, as much as 17% of office take-up in Dublin in the first quarter of the year was accounted for by co-working or flexible operators such as Iconic Offices, IWG, Pembroke Hall and WeWork. Europe's largest co-working group, Talent Garden, also recently announced plans to provide up to 350 workspaces at the Dublin City University campus in North Dublin. Prime headline rents in the office sector in Dublin remain stable at €700 per square metre or €65 per square foot. Meanwhile, the overall rate of vacancy in the Dublin market is now sub 6%. A scarcity of modern premises along key road corridors continues to exercise occupiers in the industrial and logistics sector of the property market. However, now that prime industrial rents in the capital have breached the €100 per square metre benchmark, viability has improved and a number of speculative schemes are finally under construction, while others are entering the planning process. New development will in time alleviate the supply pressures that have characterised this sector of the market over recent years. However, in the interim, prime headline rents, which are currently in the order of €102.20 per square metre or €9.50 per square foot, will continue to increase, with a further 7% uplift anticipated by year-end 2018. Despite inherent shortages of modern industrial and logistic stock, take-up in the Dublin market in the first 3 months of 2018 reached an impressive 71,595 square metres, up 41% on the same period last year. In the retail sector of the economy, there's been continued activity in the property market over recent months, buoyed by strengthening consumer sentiment. As has been the case for some time now, Indigenous Irish retailers and international retailers are most active at present, with UK retailers remaining reticent to expand or roll out new stores until there's more clarity on the outcome of Brexit negotiations. Retailers continue to focus their attention on the better performing shopping centres, retail parks and high streets, all of which are boasting negligible vacancy, if any, which in turn is boosting rental growth prospects in these particular locations. Following a long winter, retailers are now hoping for a busy summer sales season ahead. With house building in Ireland finally beginning to show signs of increasing, this will prove a welcome boost for retail parks in particular. Against a positive economic backdrop and buoyed by impressive volumes of occupational activity, investor appetite for core real estate investment opportunities in the Irish market remains strong. Demand has been boosted in recent months by investors who are keen to avoid hedging risk by investing in euro-denominated jurisdictions such as Ireland. Despite an underlying scarcity of core product, we are seeing increased activity happening off-market. Total spend reached almost 930 million in Q1, a strong result for the first 3 months of the year, buoyed by the completion of 3 large transactions of excess €100 million. More than a quarter of this activity in the first quarter happened outside of the core Dublin market. Total returns in the Irish commercial real estate sector reached 2.4% in Q1, according to the latest MSCI Irish Index, with total returns to the end of the quarter 1 running at 6.8%. The growth in appetite for alternative investments such as PRS or build to rent, and indeed student accommodation over recent months, is particularly noteworthy, as is the increase in demand for good investment opportunities outside of the core Dublin market, with particular strong demand in cities such as Cork. With the bulk of investors' demand focused on prime assets, pricing is now critical for secondary properties where the pool of buyers is somewhat thinner. Prime yields in all sectors remain stable at this juncture, although some further tightening is expected in the PRS, student accommodation and hotel sectors over the coming months as assets trade and new transactional evidence materialises. According to CBRE research, 37 development land transactions totalling more than 167 million completed in the Irish market during the first quarter of the year. This compares to 28 transactions totalling approximately 104 million completed in the same quarter last year. Despite pent-up demand for development land in the current market, very little of scale is being traded, which is obviously frustrating for the many end users looking to acquire prime sites at present. Encouragingly, we expect several sizable land parcels and development opportunities to be brought to the market over the coming months, which will no doubt be keenly bid, as demonstrated by the strength of demand for a prime PRS opportunity at Hanover Quay in Dublin Docklands, which was offered to the market recently. We also expect strong demand for 274 apartments and an adjoining 3.97-acre development site at the Grange in Stillorgan in Dublin 18, which has also recently come to the market. It remains to be seen if the government's decision to establish a new National Regeneration and Development Agency, or the NRDA, with the aim of acquiring private land beside existing state or semi-state holdings to facilitate land assembly for housing development will ultimately prove effective. The recently revised design standards for apartment development have, however, been broadly welcomed within the industry. Coupled with a welcome increase in the volume of planning permissions being granted under the Strategic Housing Development's fast-track process, these initiatives should improve momentum in the delivery of much-needed residential development in the medium term. The one disappointment is that we still don't have clarity from government on height. Finally, the hotel and licensed sector of the market. As the official summer tourist season now kicks off in earnest, all the indicators point towards the prospects of a good season ahead. Although UK visitor numbers are down year on year, Visitor numbers from other jurisdictions are up, and indeed tourism revenues in Ireland are firmly on course to reach €6 billion this year, which bodes well for the hotel sector and indeed the wider economy. Demand will be further boosted by the commencement of new direct air routes, including Cathay Pacific's 4-time weekly direct flight between Ireland and Hong Kong, and Hainan Airlines' new flights between Dublin and Beijing, which are due to commence next month in June. An extra 10,000 seats each week on Ryanair flights to and from Germany, and 60,000 seats on flights every week during the summer to and from the US and Canada will also help to boost overseas visitor numbers to Ireland. Dublin is said to be the biggest beneficiary as demand for hotel rooms continues to outstrip supply in the capital. RevPAR in the city increased by 9.8% in the year to March 2018, according to Hotstats, while occupancy in the capital was up 2.1% year on year. While hotel demand continues to grow, approximately 1,300 additional hotel bedrooms are due for delivery in Dublin in 2018. According to our research, 4 hotel properties totalling 199 million between them were sold in Ireland during the first 3 months of the year. This relatively low volume of transactions completed in the first few months of 2018 is, however, not representative of the volume of underlying activity in this sector of the market. The hotel property market has been extremely busy in recent months, with considerable activity underway off-market, which will boost transactional activity later in the year when these sales ultimately conclude. Some high-profile hotel assets are currently being prepared for sale and due to be formally launched over the coming months, offering some options to the many hoteliers and investors seeking opportunities in this sector of the market. There's particularly strong demand for hotels from US funds and for hotel investment opportunities in Europe at present, with many of these funds looking specifically at opportunities in the Irish market. Prime hotel yields remain stable at this juncture, but are expected to strengthen later this year as new transactional evidence begins to materialise. Much of the focus in the commercial property market in Cork in recent months has been on concluding some of the occupier transactions that are underway in the office sector and indeed preparing investment assets for sale. Core properties that are being offered for sale over the coming months are likely to be keenly bid, considering the strength of investor appetite for good provincial investment opportunities over recent months. There's particularly strong demand for prime office investment opportunities, and following the successful completion of the Elysian residential investment sale to Kennedy Wilson in recent months, we're also witnessing very strong demand for PRS and build-to-rent opportunities in the Cork region. There's been a particularly encouraging reaction to the sale on behalf of NAMA of the 11.35-acre live at the Marquee Ford distribution site in Cork Docklands, which was formally launched for sale, guiding €8.5 million in recent weeks. This site is due to go to best bids later this month. Prime yields in Cork remain stable in all sectors at this juncture, and as new transactional evidence emerges in due course, this situation is expected to change. Meanwhile, prime industrial rents in Cork have increased in recent months and currently stand at approximately €75 per square metre. In summary, as summer finally makes an appearance, all sectors of the Irish commercial property market are experiencing strong volumes of activity, and the forecast is for continued momentum over the coming months. To download our full bi-monthly report, please visit the newsroom of our CBRE Ireland website at news.cbre.ie.